Welcome to Financial Focus, brought to you by Gulf Coast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have provided North Florida savers and investors sound, comprehensive financial guidance for over 25 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the team at Gulf Coast Financial Services founder, CEO John Kuykendall, our resource each and every week for a common sense approach to planning. John, welcome back in.
Thanks, Peter. It's great to be here. It's been a while.
Yeah, excited to have you on. Now, you had some surgery and then we're recovering from that. So took a few weeks off here, but back and almost full strength.
Almost. I had a hip replacement, and that's moving right along. And so hopefully pretty soon I'll be through with rehab, or PT as they call it. I don't want to call it rehab, but hopefully that'll be behind us and we can move on.
I hear the recovery is most often the most difficult and painful part.
Yeah, there's no pain. It's just getting my my stride back. I'm walking with a limp and have a cane, but yeah, I'm able to get around and move, and still climbing the steps every day to the office. So I guess we're okay.
Not to make light of your situation, but to segue, I was going to say, kind of like in the market, the recovery is difficult and takes a long time.
Painful sometimes too.
Painful.
Yes.
Yeah, indeed,
Yes.
indeed. And that's kind of what we're talking about today, is the fact that in our financial progress, John, we all understand and know we're going to have some risks along the way. And in fact, probably no financial option without those risks. But we also need to understand where and when those risks are appropriate. We need to be able to quantify them. And there's also a balance of protection that we are all looking for.
Oh, sure, Peter. I think that's one of the problems that a lot of people have, is that they want to be in the market. They want to make a lot of money, but the first sign of trouble, they bail, and then they stay out too long and they don't make anything. So it's really a catch-22 for them, as far as, how much risk do I take? How do I judge my risk, gauge my risk, and how much risk am I going to be happy with? And what we've always said is that I want to give my clients as much risk as they can take to sleep at night, because the more risk that, a good friend of mine who was a mentor, he's now passed away, but back when I started in banking, he told me that it was a risk reward situation. You can't get the reward without a certain amount of risk. But on the other hand, there's no reward with no risk. So it's hard for people to understand that.
Well, all I want my money to do is grow by 30% per year without any losses, and to come out tax-free to me into the future. So I leave that in your hands, John.
Peter, it's funny because just before lunch, I got an email that a client is not happy with their returns. They don't think their money's moving fast enough. And so I looked at the account, and we pulled a report, and the client has been with us less than a month, less than 1 month. They're up 2.5% for the month.
Amateurize that out, and we're making 20% returns. But that period of time is not even a fair gauge to make any assessment.
No, I mean, if you're not in this for the long haul, you shouldn't be in the market. I mean, you should put your money somewhere where there is no risk, because the market is going to give you a certain amount of risk. We know that.
Yeah. So, John, I want to back up, because when we talk about risk, when we talk about risk tolerance, these are terms that we hear when we are setting up our accounts and thinking about our investment strategy, or trying not to think about our investment strategy, but they're a little bit ambiguous. And so if you would, could you maybe define and help us quantify what risk and what risk tolerance means to the average investor? Because it sounds like that individual probably doesn't have a whole lot of risk tolerance there, would be one of the issues.
Right. And then you said it right on the head there. Risk tolerance is the amount of risk you're willing to take before, I like to say, you panic and go back into cash. And so it's an amount of risk that I'm willing to take, my threshold of pain, as I like to call it. So everybody's risk tolerance is different. Now, the amount of risk we get is the amount of risk we have in the portfolio. Fortunately, today there are several software packages, such as Riskalyze, that are very good, that will measure the amount of risk in a portfolio, and we can gauge that and show the client, in a down market, how much they could lose, and in an up market, how much they can gain. And then we can figure out with their risk tolerance where they should be in that risk cycle. So it's really much easier to define that now. Back in the old days, we defined risk as the amount of stocks and bonds we had in the portfolio. And you know as well as I do that you can have bonds that are just as risky as stocks. So this new software really helps us analyze that and keeps us on track.
It almost should be risk intolerance. Where is
Yeah.
your risk intolerance level?
Right.
Or as the young kids, the millennials, they can't say any full sentences. They have to shorten everything into acronyms. FOMO, fear of missing out. On the other side of that, if I'm out of the market completely, I got to jump back in because I've got that fear of missing out. There could be gains there that I could be missing.
Yeah.
Hard to balance those two things.
It is hard to do that. And I saw something today that kind of justifies that. It was what happens if the Democrats won the election or the Republicans. And the amount of gain or loss really wasn't that much different between the two. But the fact that if we had taken our money out of the market before the election, like a lot of people wanted to, the scale was huge in the amount of money you would have lost.
I actually saw an interesting chart. It basically said that I can't remember if it said economic growth or market growth. And I have to assume economic growth because it went back to like the 1700s, all of presidential history. And it basically said under a Republican leadership in the White House president, the 4-year aggregate growth average of the economy was 59%. And under Democratic leadership in the White House, it was like 56% 4-year aggregate growth. So essentially it said this is a negligible difference and probably attributable to other factors.
Right. But people really got carried away, and a lot of people wanted to be out of the market before the election, and that would be the wrong thing. There's going to be volatility. We still have volatility. We're going to have volatility forever because that's part of the market.
Yeah, indeed. So I guess, can we bring that a little bit more down to our individual level? If there's going to be volatility in the market, John, I want to protect myself against it. How do I go about doing that? And what are those protections that are available? And then follow up to that, if you can get all of this into one, by missing out on the market, there are other risks that I'm going to be exposing myself to on the other hand, right?
Well, yeah. I mean, the fact that if we're not in the market, then we've lost the opportunity to make money. Inflation's going to eat me up. I'm not going to be on my way to retirement. I think the thing that we say on this show over and over and over again is that the income plan, an income plan that shows us how we're going to grow our money steadily and how much money I need for retirement, is the safest way to keep risk at bay, because then the amount of risk I have really doesn't bother me because I know where I'm headed.
All right.
And without an income plan, we're taking a road trip with no map.
So John, there's risk in the market. It's over here.
Yeah.
How do I protect myself? The paycheck.
Right.
The income plan.
That's the income plan.
The budget, the cash flow. That's the protection that's available and that I need to put in place.
Well, Peter, when we work, we get that check every month, every 2 weeks, whenever, and that check is our safety net, because I know no matter how much I spend, I've got that check. And one of the things that we've done in society today is we've eliminated a good part of the check or the guaranteed income, sustainable income, out of our retirements because we no longer have the pensions. So what we have is a Social Security check. And then in some cases, we may have a check from an annuity or whatever, but the majority of people are trying to make their money, get that paycheck from their investments. And that's a lifestyle that they're not going to be able to sustain without an income plan. So I can write my own check every month and I know how much I can write.
But John, there are solutions, strategies, ways to structure and layer the assets that sort of can recreate the security of that paycheck for us in retirement.
Well, sure. And one of the best ways is an annuity, because with a fixed indexed annuity example, I'm not going to take the market risk. The insurance company is taking that. But what I'm going to be able to do is get a check every month for as long as I live. And that, in some cases, is huge for these people, especially when their spouse dies away and we end up with one Social Security check instead of two. A lot of people forget that. They forget that when we lose a spouse, we only get to keep the bigger of the two checks. One check's going away. Also, an annuity can give us some long-term care protection, because a lot of those will have a doubler for 5 years or some term that I can get extra money.
That is, John, at least a 1/3 reduction in income. At worst, probably a 1/2 reduction in income. And that's something that we all need to sort of work into our retirement projections long term. We don't like to think about it at 62 or 65 on the day that we retire, but at 82 or 92, eventually that's kind of an inevitability that there's going to be a loss of some significant stream of income. It's something that we need to plan for proactively.
And Peter, that is something that we plan for here. When we do our income plans, we have one of the spouses dying ahead of the other one, showing them how much money we're going to need and how much money we're going to be short. And that's huge. I don't think that a lot of people realize how much that's going to affect them. They think they're just going to get both checks, and they're not. So, but their income or their expenses are the same.
Well, again, as we're talking about risk, most people think of the market. We're talking about risk to your lifestyle. And I think that's where the rubber meets the road, John. When we talk about risk, we think about our money. We think about the dollars that are invested in the market.
Right.
Boil it all down, risk to your income, that's about risk to your lifestyle, your quality of life, and your confidence in living and spending.
Right. And the two, Peter, when we have this income plan, then we've got a roadmap we can follow. We know how much money we can take out. We know that I can put my new roof, my new car. We put all that in the income plan, and then it's all built in so that we know we have enough income and we can adjust our lifestyle accordingly. I think it was not long ago that you talked about, giving away all the Halloween candy up front.
Yeah.
And then not having any because I spent it the first 3 years of my retirement, right?
Right. Yeah. The bucket of candy is kind of the perfect analogy for your retirement savings. Do you budget it and then you're left with a whole pile at the end of the night? You've got to eat it all and your waistline doesn't forgive you, or do you hand it all out and risk running out? And the older kids come later. They are often not kind if the lights are out.
No, they're the ones that trick. And so when we go trick or treating, but what we need to do is we don't want to be so tight that we don't do anything the first years. I like Tom Hegna's analogy that we are in you have 3 segments. The go-go years, those are the years when you first retire. The slow-go years, which are the next segment, and then the no-go. And I see that with my clients. That analogy is right on. I'm going to spend more money the first 5 or 6 years of my retirement than I am later. It's just natural. So we build that into these plans as we work with them.
Well, again, I think, John, as we've talked about risk, we all are concerned with risk. Maybe during good times in the market, we keep it as a kernel in the back of our minds, not really prevalent. But then all of a sudden, swiftly and uncomfortably, it becomes forefront in our minds and top of mind. But as we talk about this, the solution to risk is planning and having a plan. And that's where we can identify the protections to put in place.
And Peter, while we like to put all of our money in the market, pull out a certain amount to live on, we know that that 4% rule doesn't work anymore. But there have been times, several times in the market, where the market hasn't grown at all. We've gone 10, 15, 20 years where the market stayed the same. And if we're pulling money out during those periods of time, we're not making any headway. We're eating our principal.
Yeah, most recent example, I guess, would be what they call the lost decade. It was really about 12 years after the year 2000 and the dot-com bubble burst, then 9/11, then the Great Recession. It really took 10 to 12 years before the market broke out above where it had been previous to the year 2000, John. And
sure.
And so, hey, if we have the security of a paycheck during that time, if we're contributing and saving and investing during that time, it's an advantage and we can still make forward progress. But if we are living off of assets during that 10-year period with all that volatility and fluctuation, there is a substantial increase in the risk to us running out of money.
Oh, yeah. Yeah, I mean, I think that's why when we build our income plan, we like to make sure that we spread out the components. We're not looking just at the market. We're looking at life insurance, annuities, other ways that we can give you an income. And several cases we've been able to do that with life insurance, so that if one spouse died, we had a bundle of tax-free money that we could bring in and then sustain the other spouse until she or he passed away.
And that really is the point of insurance, right? It is identifying a risk and leveraging our money to address that risk, using as little of our money as is necessary to protect against it.
Right, right. But you know, the thing is if we don't plan early, and if we don't, as I say, we like to say, Brent and I like to say, that plan is a living, breathing document. And so we want to update it every year. If there are any major changes, we want to know about it. We want to look at it. And, you know, we want to do tax planning. Taxes are going to be a huge hit in the future. It's a risk that a lot of people don't realize. But what do we have now? About 40-something $trillion of debt.
More, I hear, if you include Social Security, Medicare, and Medicaid, and those liabilities.
127 trillion, something like that, if you include everything that's owed. But if you just look at the debt, we're in the 40s, and we're talking about getting another stimulus package. So that could hurt. Think of what taxes have no place to go but up.
Right.
And we have to do tax planning.
A whole nother risk that we probably could dive into and talk about how planning, again, is the solution here. But there is some things that you need to do to address not only the risk of the market, but the risk of taxation, the risk of low interest rates. There's a myriad of different risks. And John, that's why no one solution is a one size fits all and absolutely right for every dollar. That's why you need to have a comprehensive approach to planning. That's why John and his team there at Gulf Coast Financial Services make the time available to you to come in for that complimentary review, the retirement planning strategy session. If you'd like to take them up on that, pick up the phone, give them a call, 386-755-9018, 386-755-9018. You can go online, gulfcoastfinancial.net, gulfcoastfinancial.net. By the way, previous editions of the podcast, they're archived there online. Lots of great topics that John has covered week in and week out over the course of this podcast. And John, we've dove deep into taxes a time or two before.
We have. We've dove in. There are several subjects on there that everybody would benefit from listening to. A lot on income planning, because we really stress that all the time, Peter. But taxes, that was a couple of issues that we did. And taxes are important. Can't get around it. No. Longevity. Tom Hagner says that longevity is the multiplier of all the other risks, because the longer we live, the more chance we're going to have of running out of money.
Well, again, you know, that's ultimate risk that we want to avoid, and it's through proper planning that we're able to address that. There are so many things that are outside of our control, but the plan allows us to identify them and put in place a plan for us to deal with them and protect ourselves against them. John Kuykendall and his team, again, can help you put that plan together, or even if you already have a plan, help you troubleshoot it, help you poke holes in it, help you spot and identify holes that have been left unaddressed or red flags, pick up the phone, give them a call, 386-755-9018. Lots of information, reports, tools, calculators available online, gulfcoastfinancial.net. Or even if you've got just a specific question that's been on your mind, give them a call, talk it over, 10 minutes, you have an answer to your question. 386-755-9018. John, we always appreciate seeing you, and welcome back to Financial Focus.
Thanks, Peter. It's great to be back. It's great to be here. And I just got to tell you that, I'm living the dream, got a new hip. I'm ready to go.
Wonderful. Well, we'll see you out and about riding the motorcycle again soon, John.
Thanks, Peter.
Take care.
Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting gulfcoastfinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services Inc., a registered investment advisor in Florida. Gulf Coast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.